Welcome to Revere Asset Management's Your Money with Danny Stewart
The market will always overshoot to the downside and to the upside.
and Don Vandenbord.
Because it's not how much you make in the markets, it's how much of that you can keep.
Rules, rules, rules. Man, I hate rules. So does my gorgeous wife. She really hates rules. Almost as much as she hates me telling her what to do. It never ends well, yet I never learn, but I digress. So as a freedom-loving Americans, we hate rules and restrictions. And especially as fiercely independent, give me liberty or give me death, revere patriots like us. Yes, I know that was Patrick Henry. A bunch of history buffs. You don't have to reach out and call. I know. No, you didn't get me. But as Americans, as mudbloods, as the melting pot, as the mixed breeds of all the different continents all coming together, we kick the British out. We hate rules. However, sometimes rules are very good, like a busy intersection. You've got a red light you need to stop at so you can avoid getting T-boned. That's a very good rule. It's saving my physical health. It's saving my life. But I also want good rules for my financial health. So my money, that's the name of our podcast. Your money, it's your money. So your money doesn't get figuratively T-boned. You don't want to get T-boned. That's why I love rules when it comes to investing. Price is truth, no exceptions, period. So like my wife, when I stopped arguing with price, I had peace. I never had to apologize to a client again. I'm still apologizing to my wife because I still can't do that. But I never had to apologize to a client again. This is the easier, softer way, the path of least resistance. It's the path with the most gains and the least pain, in my opinion, on a risk-adjusted basis. Look, if you can find a better mousetrap, a better way to do it, let me know. I may come join you because I need my money managed too. In fact, I always say on the show, if you want your money managed just like my money, our family's monies, come join the Revere family. But anyway, so I digress. Now I'm going to go to the mailbag because it's going to lead right into this. These are clients, prospects. If you got a stock or a comment you want talked about, send us an email. Just go up to the revereasset.com website and there's a contact us. It'll send me an email and ask a question that you like. All right. So this is 828 from DC. Hello, Don. Thank you for managing my money. I appreciate it. I forgot to ask, as a new client, what is your policy or set of rules around holding individual stocks through earnings announcements? Understanding your approach is helpful in managing my own expectations. Thank you, DC. Don, of course we have a risk-managed process. We never want to lose more than 1% of the total portfolio value on an earnings blow-up. So we take the expected market maker's move, we multiply it by 2, so the expected move, say the earnings surprise, they disappoint or they beat it to the upside. The expected move may be 5% either way, one way or the other. So Don's going to double it, make it 10%, and then he's going to back into his position size. That's how much the stock could lose if it really, if it was double as bad as the expected move. For example, if EMMM was negative 10% expected negative move, it had an expected negative move of positive or negative 10%, then we would have a negative 20% worst case scenario. To stay within the 1% maximum loss, our position size would necessarily have to be 5%. Thanks for reaching out. So you actually back into the position size. So folks, this mailbag goes back to that topic of people are scared of how they're going to get into the markets, how we're going to assimilate them, how we're going to get them into our process without getting creamed right off the bat. So people are worried about how we get them assimilated, get them into the market because they're worried about the markets being too toppy right now. But then there's rules for ongoing management. There are rules for selling. We've got rules around every part of the investment process, from the onboarding, the assimilation, the ongoing management, the performance tracking, and the reporting to you. So with that, I am going to go to the team. So let's go to the team Revere. And but by the way, so here's the bottom line. Are you any good investing on your own if you're doing it on your own? Is your advisor any good? Because if they're not, if you just a difference of 2 or 3%, folks, if you got hundreds of thousands of dollars, just 2 or 3% can be hundreds of thousands of dollars on the back end. If you're talking about 20, 25, 30, if you're talking about a long time, okay? If you got 7 figures, you could be talking about millions on the back, and especially if you're talking about a 4, 5, or 6% spread. I mean, most of these pie charts are us. They're making 7% and going down 30% every 5 years or so. We're making way more than that and going down a third of that. So with that, let's go to the team and find out what the rules are that we have and how Don manages. Don?
Got it, Dan. So let's start off the way we usually do with where are we in the current state of the market. And last Friday's podcast came right on the heels of Jerome Powell's Jackson Hole statement. And I'm going to go to a shorter term chart here. Let's go to we have a bug in the on market surge in the look what's missing, just what I wanted to talk about last Friday's action. But suffice to say, let me draw some lines here. We had a big up day on Friday, and it was on the heels of Jerome Powell's Jackson Hole speech, where the market interpreted it as him finally giving in to the fact that it's time to cut rates. Monday, a little bit of a tight consolidation, pullback early Tuesday, but that was it. And then we've had 3 days up. This is one of the reasons why in our video every night we do a day count, because normally after a third day up, you can expect some contraction, consolidation in the market. But what we're seeing today is a fairly harsh pullback relative to what we've seen the prior 3 days. In fact, we've given up the lows of Thursday, the lows of Wednesday, and we're back inside of the action from Tuesday. And so, of course, the question is why? Well, let's take a look at NVIDIA. They reported earnings after the bell on Wednesday. And here's the candle on Thursday. It shook people out to the upside and to the downside, but it undercut and held the 21-day moving average. My expectation coming into today was that the lows of that day, that earnings reaction day, would hold, but they didn't. They're breaking. No technical damage has been done. Because it's still holding, NVIDIA I'm talking about, is still holding this red line, the 10-week/50-day moving average. So consider it a normal pullback, but also consider it a minor expectation breaker. But the point of Thursday night's video was not to focus on NVIDIA. It was to focus on the fact that it lit a fire under all the data center names, that all the names that have some sort of connection to the great AI data center construction and implementation that's going on. I have a list of 50 names that are related to that, and without fail, they were, let's say, I think it was 44 of them were higher yesterday. But today we're seeing the exact opposite. So that's a minor expectation breaker. Normally, when you see a day of strength of something, you want to see follow-through strength to it, and we're not seeing that. So then, of course, the question is why. We know that we only obey price, but as humans, we want to marry a thesis that we have to the actual price action that was going on. So we did a few ads to some AI data center names on Thursday and early Friday, but we're seeing deterioration there. So what to do? Use the low of that inflection point. We do this frequently, not only in the indexes, but also in the individual names. Now, NVIDIA has violated that. So that means to us, pause don't add more NVIDIA because it's weakness. We like to add on constructive weakness. We don't consider this constructive weakness. Also, volume's 50% above average. Now, we got to put a little asterisk in there because BABA reported earnings this morning, and they said they're developing a chip that can take the place of some of the shortage of NVIDIA AI chips. And that may have been enough to trickle through the entire data center complex to cause weakness. But it is what it is. We take it day by day, and we always have our stop set, but mildly disappointing expectation breaker across the AI data center names. So, of course, we want to go one level up, and that is to the overall major indexes. As far as the S&P 500 goes, we'd like to see it hold the 8-day moving average. It's teetering right on there. We also have to remember that it was 3 up days in this index, so a normal pullback is to be expected. Now let's go to the NASDAQ 100, and what we're seeing is we also had the 3 up days there, but a harsher break, down 1.3%, now sitting on the 21-day moving average. We had 2 closes below the 21 a week and a half ago in the NASDAQ 100 as it had that period of relative weakness where money flowed into defensive names, defensive sectors. We're also seeing that money flow into those defensive sectors again today. When I look at my big quote screen and I see what is up, financials are up, basic materials are up, staples are up, healthcare is up, utility is basically flat, and real estate is up. Those are all the defensive sectors. So it's not money leaving the market. It's not a broad sell-off. It's focused weakness on XLK, tech, XLY, discretionary, and XLC, communication services. Those are considered the 3 quote-unquote tech spider sectors within the overall S&P 500. So the fact that money is rotating out of the tech sectors and into these other sectors is a very positive, definitely a positive. You can see here's RSP. This is the equal weight S&P 500. Note the relative strength there after a big period of relative weakness. The relative weakness was because the NASDAQ 100 was outperforming. Remember, those are big cap stocks that they have a top heavy impact on the S&P 500 from a market cap perspective and also on the NASDAQ 100. But great relative strength on RSP today, only down 0.25% versus, as I said, the NASDAQ down 1.2% and the S&P 500 down 0.75%. So the question is as to whether or not the money is broadly leaving the market. The answer is no. But something happens on Tuesday, the first trading day, because we were entering a 3-day holiday, and the calendar flips to September. September is notorious as a weak month in the market. It's normally weighted toward the back half of it, but is it possible that that we do get the September sell-off? Anything's possible. And as stewards of our clients' money, we're prepared for every outcome. That's why every night in our videos, we give a quote, balance at risk. What is the balance at risk if the market would roll over, go to the downside, and every single one of our stops would get hit? Right now, that's approximately a 6% pullback across the averages. That doesn't even take you to the 200-day moving average on the S&P 500, which is currently 8.3% above the 200-day moving average. But what happened? It goes off in layers. We'll get stopped on our individual names. We'll get stopped on some sector ETFs. We'll get stopped on our broad index exposure if we break the 50-day, the 100-day, the 150-day moving average. Money goes in, money goes out in layers. Another negative for the market is that crypto has been acting weak. Bitcoin, strong for a long time, broke the 50-day moving average, had a classic bear flag back up into the 50-day, and a gap down this morning and a breaking of that low. We have our Bitcoin on the chopping block. We've sold some of it today. We may sell the rest of it by the end of the day. Let's look at Ethereum. This has been the leader. Big up day on the Jackson Hole reaction that was last Friday, as I mentioned. We're down near the lows of that level. So Bitcoin has broken that level. Ethereum has not. And it's sitting on the 21-day moving average, which is where we have our stop set for this position. So Bitcoin weaker, Ethereum still holding up. It gave up a bunch of the gains. The market overall, money went into AI data center during Thursday. It's coming out during Friday. We note the lows of all those individual positions, and we stick to our stops. But for right now, across the broad market, this is a normal pullback after 3 days up, with rotation out of tech into the other sectors. And I said it 1,000 times, I'll say it one more time. This is why we keep a broad core position in the S&P 500, because of days like today. If you have all growth names, you're getting hit across the face with a harsh smack. But that money flowing into the value sectors cushions the blow if you have a core position in the S&P 500. So S&P is down 0.7, Grotection's down about 0.9. There's no significant difference. And it's just the rotation taking place. Dan, I'm sure you have a few questions on that. Why don't you give them to me?
Well, it's not really a few questions, but what I'd like to make a couple comments. So, folks, a couple of things. If you're doing the pure CanSlim, pure IBD with the entire portfolio, that can get a little bit volatile. It can get a little bit wild because you got big positions in stocks. So that's why Don uses CanSlim methodologies on roughly half of the portfolio with the individual stocks. And then he's got the ETF portion of the portfolio that actually smooths the ballast and makes it much easier ride when like he said, when they are taken to the woodshed. So when the market first starts to pull back, normally leading growthier names are the first things to sell off. So leading stocks lead on the way up. That's why they're called leading stocks. That's a definite. They also lead on the way down normally. They sell off the most, the quickest. So the first thing is the leading stocks sell off, so you'll see a rotation into value. But then during bear markets, even the value side goes. So the first things Don's doing is, do we just rotate from tech to value? And then do we even get rid of the value if it's getting ugly enough? Those are the different levels of breaks that we have, the different levels of rules. So we got individual stop levels and rules on the stocks, individual stocks. We've got individual sell rules on the ETF portion, and we've got rebar, the Revere estimated balance at risk, on the total portfolio. So not only do we have a sell stop on every single individual position in the portfolio, we also have a sell stop on the entire portfolio itself. What does your advisor have? And what do you have? How are you managing it? It's a good question. All right, Don, go ahead.
All right. And the key to that, Dan, and one of the reasons why the buy and hold stay in crowd takes shots at active managers like us is they'll say, well, you have to be right twice. You have to be right on the way out, and you've got to be right on getting back in as well. And our answer, of course, to that is no problem. We detail our rules for entry and for exit every night in our videos. It's dictated by the trend gauge, which is shows the health of leading stocks as well as the health of the indexes across 3 time frames. Incremental changes both to the upside and to the downside in our portfolio holdings described on video, never edited, never taken down. They're out there for years. We're the most transparent advisor that you will find, and one of the very few advisors that take active management and downside protection seriously. So let's turn it over to the guys. We've got some good presentations this week, focusing on a couple of different themes. We'll start off with Connor and Tesla. What do you got to tell us about Tesla, Connor?
Yeah, so Don was mentioning NVIDIA reported earnings this week, and if you ever have the chance, listen into their conference calls, you can learn a lot. And one notable sentence that Jensen said was on the earnings call was that enterprises have been opened up as a result of agentic AI and vision language models. We are now seeing a breakthrough in physical AI in robotics and autonomous systems. So that definitely jumped out to me. And basically the next phase of the AI trade is agentic AI and the application of it. And obviously robotics is a very exciting area in that. And Tesla's basically the main play in the public markets to capture that. They're involved heavily in robotics through their development of the Optimus humanoid robots. And then their mass production of the Optimus Gen 3 model is projected to begin in early 2026, with Elon Musk targeting up to 1 million units annually within 5 years. And so, and Tesla is just consolidating right now. If you go to a monthly chart, you can see that historically, the way that this stock acts is really, really strong moves up, followed by years of sideways. And you can just see in this monthly chart how it's stair-stepped higher, basically since it IPO'd. And currently, it's in a big, big range and getting really tight on the right side. So this is it. You know, it's not breaking out yet. It's just in a range. But I am watching this, especially with Jensen's comments on robotics. It looks like this name just needs a catalyst with some volume to break out of the range. And everyone's aware of the robotics, how it should be a big theme, but for now, it's just waiting for price action to cooperate. And once they start, with the Optimus humanoid robots, if there's some positive developments across that front and Tesla starts to gap out of this range, this could be the leader for the robotics trade. So watching Tesla, and then another smaller name that's been in the Turbo 12 a couple times is SYM. And this is another robotics, pretty pure robotics play as well. And as you can see, this one's had a very strong run up this year, and now it's pulling back to the 50-day moving average. Definitely the chart's quite choppy as of lately, but sitting on the 50-day moving average. And if you look at the weekly chart as well, it is right at the 10-week moving average. And this has got a very big base as well. So perhaps this also needs a catalyst, but a little bit about this, Dave, is they have an ongoing multi-year partnership with Walmart, basically deploying their robotics across Walmart regional distribution centers, and SYM just specializes in advanced robotics that transform supply chain operations for large retailers and distributors. So as this technology expands, you could see a lot of adoption for this product. Decent sales, still not making money, but again, you never know when this trade is going to heat up. All you can do is have these names on your watch list, have some price alerts set up, and if there starts to be some positive catalyst, maybe an earnings announcement, gap up, that's when the trade could come alive. So these are just two names in the robotics sector that we're watching, looking for positive catalysts and watching as an emerging theme in the next couple months.
Yeah, no earnings to speak of, losing money 2 of the past 3 quarters. But if you look ahead to next year, and also for the fiscal year of 2025, which is staggered a little bit because they've got a September year, you can see they're slated to start making money. One other thing, back to Tesla, I want to point out, this has been frustrating a lot of traders lately because of its the 3 steps up, 2 steps backwards type of mentality that's been going on. I'm drawing 4 rallies here, and every one of them is associated with a pullback. So the way the stock has been acting now, it's better to enter on weakness than get shaken out on temporary strength. We've been discussing this one a lot in-house over the last couple of months, keeping an eye on these pivots. First 338, got above it, faded back. Then a little bit higher, 342, 343, which we exceeded this week, now pulling back. But just pulling back in a controlled manner, no massive volume selling. In fact, if you look at the volume patterns, the positive volume has been on up weeks or up days. Very good to see there. And right now, a general pullback on below average volume to the 21-day moving average is pretty good risk reward spot there. Great segment, Connor. Let's take it over to Todd. He's going to talk about something that we've really seen work well this week, and that's some strong earnings gaps. Take it away, Todd.
Yes, we've had some eye-opening earnings gaps, and in particular, one area that's really stood out are the software stocks and the security stocks. So I'm going to go over 3 that reported this past week and one that has had some positive pin action and reports next week. Let's start with Mongo MDB and look at the weekly chart. We see this had a big monster earnings gap, but one thing I really wanted to point out is we've got record volume this week, and it looks like it's going to come in, according to my other chart service, almost double of any week throughout the past history of this stock. So right away, that's pretty notable. And just going back to the daily chart now, you can see this stock was really one of these big surprises, and you've really got a day two follow through and then a little bit of a pullback this week. And again, it was almost a 50% beat on earnings for the quarter, guide higher for the next quarter, and a guide higher for the year ahead. And software has pretty much been written off as being now obsolete, with AI potentially replacing a lot of these companies, but apparently that isn't the case, because we're seeing a lot of extreme positive action here, which makes us put these on our watch list now. The second stock that had a good reaction is Snowflake. Snowflake is no stranger to our podcast. I think I've talked about this on pretty much every earnings gap, as it's had several of them here, going back to late last year through this year. But it's just never really been able to follow through. And now in this situation, we've got another monster earnings gap here. And it seems to be potentially a change of character this time, as, going back to the weekly chart, Don, we can see here it's now clearing 2023 levels, as well as all these prior gaps that it's been, it's been stalling at through the past 6-8 months. So again, big volume this week, big gap, big change of character, and clearing resistance going back a few years makes us take note of this situation as an area to watch again. And now let's go into the security area, CrowdStrike. CrowdStrike was a big surprise. This area has been really lagging this past quarter, and overall, another stock that had a pretty decent beat, a mixed guide for the upcoming quarter, but up guide for the year guidance, and bounced right off the 200-day moving average. Yesterday cleared the 21-day moving average, but backing off a little bit from that level. Again, not quite ready here, but it's notable because it's a strong reaction off the 200-day moving average, and this is a change of character for this entire group. And finally, let's look at Rubrik, which is one of the stocks that we've been talking a lot about the last year as a new IPO. And again, this had good pin action off of the CrowdStrike numbers, and it's one that we definitely want to keep an eye on going into next week's report, as this has had several nice earnings gaps. Broke out of that double bottom base here back in the spring, had a nice run, actually peaked right at $103 and reversed off the last earnings report, which sent it into this latest base. And one thing you see a lot lately are these nice shakeouts, like it had 2 weeks ago, down to the bottom of that base, and reversal, which basically shows some supporting action at the low end of that base. So just another name here, a change of character in the software area, which many thought were dead, and we're seeing some positive earnings reactions and signs in this area.
All right, Todd, appreciate that. And let's go over to Ted now. Ted's going to start off with currently the largest holding in TurboTection, and they've had a lot of success with this name, ALAB. Take it away, Ted.
Thank you, Don. So just before I get started, Connor with Tesla and SYM, that's like the quote unquote end game of AI, if you will, like robotics running around, or whether it's an autonomous vehicle or a humanoid robot or some other use case like SYM in manufacturing or warehouse. I'm going to talk about ALAB and then MP, which are two names more upstream in the AI stack. And so ALAB is closest to the robotics area of AI. So what pretty much this company does, and kind of just give you a basic highlight, there's a concept called scale up networking, which refers to high speed communications between GPUs. So like in a data center, you have this rack, this server with a bunch of GPUs. And in more recent times, instead of having just one large chip powering the computer, now you have clusters of smaller chips. And they're also called chiplets that need to work together. And ALAB's products help interlink these chips so that they can run, communicate, and just know what each other are doing as fast as possible. You can kind of think of like the chiplets as states in the United States, and then like I-95 and these highways as what ALAB products do. So that's kind of like what ALAB does. And what makes this attractive, as well as MP coming up afterwards, it has three things that we look for that can potentially give us a signal that there's a great opportunity ahead: an IPO base, a catalyst gapper, and then a high type flag. And with ALAB, we initially started a position before the earnings gap coming out of that consolidation, that multi-month consolidation. And because we had a decent amount of gains heading to earnings, we decided to hold through. And on earnings, it triggered the IPO base breakout. And from that, we trended up a few days, but didn't really get anywhere. We retested the gap days lows, found support there, and now really it's just starting to build a flag. So like I talked about, the three metrics, IPO base, catalyst gapper, and high type flag, in combination with each other, can really lead to an attractive proposition. So next on NP, Don, if you can pull that up, this is even more upstream in the AI stack. They're one of the dominant rare earth mineral mining companies in the United States and rare earth magnets. And this is probably the most attractive opportunity for the rare earth area in the markets. First off, they had a Department of Defense partnership, which started that initial gap, followed by the Apple partnership. So they have one of the biggest companies in the world partnered with them, and the US government, which really just backstops just buying their rare earth magnets, subsidizing them, and investing in the company, and preventing Chinese rare earth companies from entering the US and trying to force US companies to shut down, which has happened in the past. So another example of this, you can go on the weekly chart. It also broke out of an IPO base, a longer term IPO base, off these double catalysts and gaps. And now we're starting to form a high type flag here as well. So IPO base plus catalyst gapper plus high type flag. So these are two companies more upstream of the robotics. And yeah, they're just potential big opportunities as well. And these are both owned in Turbo, and MP is owned in Grotection as well.
That's a textbook high tide flag there. Big move higher, consolidating. It actually had one that it then broke out of and tested back to the downside as a pivot. But great stuff there, Ted. MP definitely, and we own that in both portfolios. You own that also in Turbo, correct?
Yep.
Okay, good. All right. Dan, short and sweet this week from the tech team. You can take us on home.
All right. Well, listen, folks, if you like what you heard, please tell a friend, tell a neighbor, just send them to RBRK.com. Up in the right-hand corner, there's a contact us or a subscribe button. You can just put your name and email address in there, and this podcast will go directly in your inbox on Saturday morning, and our daily market insight videos will go in your inbox every evening. The market is open. If you go to YouTube, though, and just look for Revere Asset and hit subscribe, Zach, our producer, will have this podcast out by 1 Central Time. That's how our stock nerds do it. Next to that on our website is a Contact Us button. It'll send me an email, and you can ask about a portfolio review a complimentary portfolio review, or returns, how we're doing, or a stock you want to talk about on the air. And you can always call us old school at 855 Real Wealth. Don't be Wall Street's widget, their input for their pie charts or us portfolio. Learn a better way to invest with your money, because it's your money, not Wall Street's money. We'll talk to you next week on Your Money.
It's not about how much you make in the markets, it's how much of that you can keep.